They want you to believe silver only goes up from here. They want you to believe $100 is guaranteed. They want you to believe the rally never ends. They are wrong. Because while everyone is screaming silver to the moon, nobody is talking about the other side. Nobody's talking about the leverage. Nobody's talking about the bubble. Nobody is talking about what happens when $10,000 becomes $2,000. And if you think that cannot happen, let me remind you of something. In 2011, silver hit $48. Everyone said it was going to 100. Then it crashed to $26 in 5 days. That is a 46% collapse in 5 days. Fortunes were destroyed. Margin calls wiped out accounts. The rally was over, and the people who bought at the top spent the next decade underwater. Now look at where we are today. Silver is trading in the 70s. The narrative is bullish. China controls. Supply squeeze, dollar collapse, comics default. Every headline is screaming the same thing. But what if they are all wrong? What if this is not the beginning of a mega rally? What if this is the end of a speculative bubble? What if your $10,000 investment is about to become $2,000 by March 2026? While you were reading bullish predictions? While you were stacking silver based on hype? While you were ignoring the warning signs? The setup for the crash was being built. There is one missing detail in every bullish silver analysis. There is one missing detail in every silver to 150 prediction. There is one missing detail that explains why this rally is about to collapse. The missing detail is this. Every parabolic rally ends in a crash. Every single one. No exceptions. And silver is parabolic right now. So today, I'm going to show you exactly why your $10,000 investment will be worth $2,000 by March 2026. I'm going to show you the leverage time bomb that nobody is talking about. I'm going to show you the supply reversal scenario that will flood the market. I am going to show you the demand collapse that is already starting. I'm going to show you why retail euphoria is the top signal. And I am going to show you the math of how 10,000 becomes 2,000. Because this is not a prediction. This is a warning. And if you ignore it, you will learn the hard way, just like everyone learned in 2011. Let's begin. Part 1, the leverage. Time bomb, why silver rallies die fast. Let me start with the thing nobody wants to talk about, leverage. The silver market is built on leverage, futures contracts, margin accounts, leveraged ETFs, options, derivatives. Most of the silver being traded is not physical silver. It is paper claims on silver, and paper claims are built on debt. When prices are rising, leverage looks brilliant. You put down $10,000, you control $100,000 of silver. The price goes up 10%, you make $10,000. You doubled your money. Leverage is magic when it works in your favor. But leverage is a knife that cuts both ways. Because when the price goes down 10%, you do not lose 10%. You lose 100%. Your account goes to zero. That is how leverage works. And right now, the silver market is more leveraged than it has ever been. Open interest on COMEX silver futures is near all-time highs. That means the number of contracts betting on silver is at record levels. But here is the problem. When everyone is leveraged long, the market becomes fragile. Because if the price drops even a little, margin calls start. And when margin calls start, forced selling begins. And when forced selling begins, the price drops more, which triggers more margin calls, which triggers more forced selling. This is called a liquidation cascade. And liquidation cascades do not stop until all the leverage is flushed out. Let me show you what that looks like in practice. In 2011, silver hit $48 in April. By early May, it had crashed to $32. That is a 33% drop in weeks, but it did not stop there. By September 2011, silver was at $26. That is a 46% crash from the top. And the crash was not driven by fundamentals. It was driven by leverage. CME raised margin requirements 5 times in 2 weeks. Traders who were long on margin got hit with calls they could not meet. They were forced to sell. The price dropped. More margin calls, more forced selling. The entire rally unwound in a matter of weeks. Now fast forward to today. The setup is the same. Open interest is high. Leverage is extreme. Retail participation is at euphoric levels. And CME has already started raising margins. In late December 2025, margin requirements were increased. That was the first shot. If they raise margins again in January or February, the liquidation cascade starts. And once it starts, it does not stop until the weak hands are gone. So here's the math. If silver is at $75 today and it crashes 46% like it did in 2011, that puts silver at $40. But I think it goes lower because in 2011 there was no gatekeeper narrative to unwind. In 2026 there is. And when narratives collapse, prices overshoot to the downside. So I'm not calling for $40. I'm calling for $15 to $20. That is an 80% crash. And if you invested $10,000 at $75, you bought 133 ounces. At $15, your 133 ounces are worth $2,000. That is how 10,000 becomes 2,000. Now let me add another layer to this leverage bomb. Most people do not understand how thin the market actually is. The COMEX silver market trades billions of dollars of notional value every day. But the actual physical inventory backing those trades is tiny. Registered silver at COMEX is around 40 million ounces. But open interest represents contracts for over 1 billion ounces. That is a ratio of 25 to 1. 25 paper claims for every 1 ounce of registered metal. In a stable market, that is fine, because most contracts settle in cash, not metal. But in a crisis, that ratio becomes a bomb, because if even 5% of contract holders demand delivery, the system breaks. There is not enough metal, so the exchange forces cash settlement. And once forced cash settlement begins, confidence collapses. Traders realize the paper is not backed. They sell, the price crashes, and the leverage unwind accelerates. This is not theory. This is exactly what happened in 2020 during the COVID crash. Silver futures briefly traded at a massive discount to physical. Why? Because the futures market could not deliver metal. The paper price collapsed while the physical price stayed elevated. That dislocation lasted weeks, and it only resolved when the panic subsided. But in 2026, if the panic does not subside, the dislocation becomes permanent, and the paper price goes to 15 while the physical price might stay at 30 or 40. Either way, if you own paper, you lose. Now let me show you the next trigger. But if those restrictions are lifted, the entire bullish thesis collapses. And here is the part that terrifies me. The market will not wait for confirmation. The moment there is a rumor that China is reversing course, the selling will begin. Traders will not wait to see if it is true. They will sell first and ask questions later. And once the selling starts, it feeds on itself. Because leverage amplifies everything. So even if the export reversal is just a rumor, it can trigger a crash. And if the rumor turns out to be true, the crash becomes a collapse. Now combine this with the leverage time bomb from part 1. You have a leveraged market sitting on a narrative. If the narrative cracks, the leverage unwinds. And if the leverage unwinds while supply is flooding back into the market, there is no floor. The price can go to $20, it can go to $15, it can go lower. Because in a panic, there is no rational price. There is only forced selling. And forced selling does not stop until the pain is unbearable. Now let me show you the historical precedent for this. In 2010 and 2011, the narrative was that China was buying all the silver. That narrative drove silver from $18 to $48. But then the narrative reversed. Reports surfaced that China was actually selling silver, not buying. The market panicked. Silver crashed from 48 to 26 in weeks. The narrative collapsed. The rally died. And it took years to recover. The same pattern can repeat in 2026. Right now, the narrative is China is locking up silver. But if that narrative reverses, the crash will be brutal, because the entire rally is built on that single narrative. Remove the narrative, and there is nothing holding the price up, just gravity. And gravity is undefeated. Part 3, the demand collapse. Nobody sees coming now, let me address the demand side, because everyone assumes silver demand is infinite, solar demand, EV demand, electronics demand, investment demand. But what if demand collapses? What if the global economy tips into recession in early 2026? What if solar installations plummet because governments cut subsidies? What if EV sales crash because consumers cannot afford them in a recession? What if electronics demand drops because no one is buying phones and computers? That is not a far-fetched scenario. That is what happens in every recession. Industrial demand for commodities collapses, and silver is an industrial metal. 60% of silver demand is industrial. Only 40% is investment and jewelry. So if industrial demand drops by 20 or 30%, well, the entire market is in surplus. And surpluses crush prices. Let me show you the numbers. Global silver demand is around 1 billion ounces per year. Global silver supply is around 900 million ounces per year. That is a 100 million ounce deficit. But that deficit assumes industrial demand stays strong. If industrial demand drops by 200 million ounces because of a recession, suddenly you have a 100 million ounce surplus. And surpluses destroy bullish narratives. Now add another layer, investment demand. Right now, investment demand is high because everyone thinks silver is going to $100. But what happens when the price starts falling? What happens when silver drops from 75 to 60 to 50? Investment demand disappears. Retail stops buying. ETFs see outflows. And when investment demand collapses while industrial demand is already weak, you have a double collapse. Supply stays the same, demand craters, and the price follows. This is exactly what happened in 2008. Silver crashed from $21 to $9, not because supply increased, because demand collapsed, factories shut down, consumers stopped buying, investors liquidated, and the price fell off a cliff. The same thing can happen in 2026. If the global economy tips into recession in Q1 2026, silver demand will collapse. And if demand collapses while China is flooding supply back into the market, you get a perfect storm. High supply, low demand, leverage longs getting margin called. That is how 75 becomes 15. Now let me show you the early warning signs that demand is already weakening. Solar installations in Europe have slowed in Q4 2025. Why? Because energy prices stabilized and government subsidies were reduced. EV sales growth is decelerating. Why? Because the market is saturated in developed countries and consumers are hesitant in a slowing economy. Electronics demand is flat. Why? Because the smartphone upgrade cycle is lengthening and consumers are keeping devices longer. These are not headline stories. These are quiet shifts happening beneath the surface. But they matter, because if industrial demand is already softening before a recession, imagine what happens during a recession. Demand does not just soften. Demand collapses. And when demand collapses, price follows. Part 4, the speculative bubble pop. When retail is all in, the top is near. Now let me talk about the scariest indicator of all, retail sentiment. When retail investors are euphoric, the top is near. When everyone is bullish, there is no one left to buy. And when there is no one left to buy, the only direction is down. Right now, retail sentiment on silver is at extremes. Social media is flooded with silver to 150 posts. YouTube is full of videos screaming about COMEX default and supply squeezes. Reddit forums are convinced silver is going to the moon. This is not a bullish signal. This is a top signal. Because retail is always late. Retail buys at the top and sells at the bottom. That is the pattern, every single time. In 2011, retail piled into silver at $45, and then it crashed to $26. Retail sold at the bottom. In 2020, retail bought gold at $2,050. Then it crashed to $1,700. Retail sold at the bottom. Now in 2025, retail is piling into silver at $70 to $80. History says the top is near. And here is how you know sentiment is at extremes. When your barber is asking you about silver, the top is in. When your Uber driver is telling you to buy silver, the top is in. When your aunt, who has never invested in anything, is suddenly talking about silver, the top is in. That is the retail euphoria signal. And right now, that signal is flashing red. Now, let me show you another sentiment indicator, Google search trends. Searches for buy silver are at multi-year highs. Searches for silver price prediction are spiking. Searches for silver squeeze are off the charts. This is classic late-stage bull market behavior. When everyone is searching for how to buy an asset, the smart money is already selling. Because smart money buys when no one cares and sells when everyone cares. Right now, everyone cares about silver. That means smart money is exiting. And when smart money exits, retail is left holding the bag. Now add social media sentiment. Twitter is flooded with silver bulls. TikTok has videos of people showing their silver stacks. Instagram has influencers promoting silver as the investment of the decade. Now, this is not organic demand. This is mania. And manias always end the same way. They pop. So combine all the pieces. Leverage time bomb, China export reversal, demand collapse, retail euphoria. Every single piece is pointing to a crash. And when all the pieces align, the crash is not a possibility. It is a probability. Now let me show you one more piece of evidence. Historical price action. Every major silver rally in the past 50 years has ended the same way. A parabolic move higher, then a sharp reversal, then a grinding decline. In 1980, silver went from $6 to $50 in months. Then it crashed to $10. In 2011, silver went from $18 to $48. Then it crashed to $26. In 2025, silver went from $22 to $80+. The pattern is forming. The parabolic move is complete. The reversal is next. Part 5. The math of 10K to 2K, how it happens step by step. Now let me show you the exact math of how your $10,000 investment becomes $2,000. Let's say you invested $10,000 in silver today. Silver is trading at $75 per ounce. Your $10,000 buys you 133 ounces. Now let's walk through the crash scenario month by month. January 2026. Silver is still holding in the low 70s. The narrative is still bullish. You're confident. Your 133 ounces are worth about $9,975. You are slightly down, but not worried. February 2026. CME raises margins again. Leveraged longs get margin calls. Forced selling begins. Silver drops from $75 to $60. That is a 20% drop. Your 133 ounces are now worth $7,980. You have lost $2,020. But you hold, because everyone says this is just a pullback. Buy the dip, they say. Late February 2026. Rumors surface that China is considering easing export controls. The market panics. Silver drops from $60 to $50. That is another 17% drop. Your 133 ounces are now worth $6,650. You have lost $3,350. But you still hold because you believe in the long-term thesis. This is just a shakeout, you tell yourself. Early March 2026. China officially announces export restrictions are being eased to boost foreign currency inflows. Supply floods the market. Silver crashes from $50 to $40. Your 133 ounces are now worth $5,320. You have lost $4,680. Now you're panicking. You check the forums. Everyone is saying hold, so you hold. Mid-March 2026. Industrial demand data shows a sharp decline. Solar installations down, EV sales down, electronics orders down, recession fears intensify. Silver drops from $40 to $30. Your 133 ounces are now worth $3,990. You have lost $6,010. You are down 60%. You cannot believe it. You thought silver was going to 100. Now it is at 30. Late March 2026. ETF outflows accelerate. Retail capitulates. The sentiment flips from euphoria to despair. Silver crashes from $30 to $22. Your 133 ounces are now worth $2,926. You have lost $7,074. You are down 70%. You tell yourself it cannot go lower, but it does. April 2026. The final flush. Liquidation cascade completes. Margin calls force the last leveraged longs to sell. Silver bottoms at $15. Your 133 ounces are now worth $1,995. You have lost $8,005, 80% gone. That is how 10,000 becomes 2,000. Not in a straight line, but in stages. Each stage feels like it is the bottom. But each stage is followed by another leg down. And by the time you realize the crash is real, it is too late. You are already down 80%. And at that point, you have two choices. Sell at the bottom and lock in your losses. Or hold and hope for a recovery that might take years. Either way, your $10,000 is gone. And the dream of silver to 150 is dead. Part 6. The warning signs. You must watch. Now, let me give you the early warning signals to watch, because crashes do not happen overnight. They build. They give signals. And if you watch the signals, you can get out before the worst happens. Warning sign 1. Margin hikes. If CME raises margins 2 or 3 more times in January or February, the liquidation cascade is starting. That is your exit signal. Warning sign 2. China policy shift. If there is any official statement or leak about easing export restrictions, sell immediately. Do not wait for confirmation. The market will not wait. Warning sign 3. Demand data. Watch industrial demand reports. If solar, EV, or electronics demand shows decline, that is a red flag. Industrial demand drives the market. Warning sign 4. ETF flows. If silver ETFs start showing consistent outflows for 2 or 3 weeks in a row, the retail exodus has begun. That is late, but still actionable. Warning sign 5. Sentiment shift. If the tone on social media shifts from euphoria to doubt, the top is in. When the bulls start questioning the thesis, the crash is near. Warning sign 6. Technical breakdown. If silver breaks below key support levels and stays there, the chart is telling you the rally is over. Do not fight the chart. These 6 signals are your early warning system. If you see 2 or 3 of them, reduce risk. If you see 4 or 5 of them, exit. If you see all 6, you are already late. But late is better than never. Because the alternative is riding it all the way down to $15. So here is where we are. Everyone is screaming silver to 150. The narratives are bullish. The sentiment is euphoric. But the setup is fragile. Leverage is extreme. Export controls can reverse. Demand can collapse. Retail is all in. And history says parabolic rallies always end in crashes. That is not a bearish bias. That is pattern recognition. In 2011, silver crashed 46% in weeks. In 2026, it can crash 80%. Because the leverage is higher, the narratives are bigger, and the fall will be harder. Your $10,000 investment can become $2,000 by March 2026. Not because I want it to, but because that is what happens when bubbles pop. And silver is in a bubble right now, so what do? If you're holding physical silver with no leverage, you can afford to hold through a crash, but if you are leveraged, you need to cut risk now. If you are in paper silver, you need to understand the exit might not be there when you need it. If you bought at the top, you need to accept that tops do not announce themselves until it is too late. This is not financial advice. This is a warning. Because the people who survive crashes are the people who see them coming. And the people who get destroyed are the people who ignore the warnings. In 2008, people ignored the warnings. In 2011, people ignored the warnings. In 2026, do not be one of them. Watch the signals. Trust the pattern. And protect your capital. Because the market does not care about your beliefs. The market does not care about your conviction. The market only cares about supply and demand. And right now, supply is about to increase while demand is about to decrease. That is the recipe for a crash. Comment below. Do you think this crash is coming? Or do you think silver is going to 150? And remember, this is educational analysis, not financial advice. The choice is yours. But do not say you were not warned. Because when March 2026 comes and silver is at $15, this video will still be here. And you will either be grateful you listened or regretful you did not.